All right, let's dive right in. In the world of business, the concept of value seems pretty simple, right? But here's the thing. When you start looking at a company's financial statements, the numbers you see for their buildings, their equipment, or even their investments, well, they can tell very, very different stories. So how do we figure out what these things are truly worth? That's the big question we're going to unpack today. To really get to the heart of this, let's use a simple scenario. Imagine a company buys an office building way back in 1980. They paid a certain price for it, and they have the receipt. But now, decades later, how should they list that building on their books today? Should they stick with that original 1980 price, or should they use the price they could sell it for in today's market? Well, to answer that, accounting basically gives us a fork in the road. There are two fundamentally different ways to measure that building's value. And trust me, the path a company chooses to go down completely changes how we, as outsiders, see its financial health, its stability, and even its future. This isn't just about crunching numbers. It's about two competing ideas of what value actually means.
Okay, so let's take a look at the first path. This is called the historical cost method. I want you to think of this one as an anchor. It's solid, it's stable, and it literally moors an asset's value to a single, unmoving point in the past.
So what does this mean in practice? It's simple, really. With historical cost, assets are put on the books for the exact price that was paid for them when they were first bought. And here's the absolute key. That number is locked in. It does not change, ever. It doesn't matter if the market for that asset goes through the roof or completely crashes. Let's make it even simpler. Imagine you bought a house 30 years ago. The historical cost is just the price printed on that original sales receipt. It's a fact. You can verify it. And on a company's books, that number is basically set in stone. It's a permanent record of what happened on that day.
Now, this approach has a really clear trade-off. The huge upside is stability. The numbers don't jump around every time the market gets nervous, which makes financial reports really predictable and easy to compare from one year to the next. But, and this is the big but, the major downside is that this stability comes at the expense of relevance. That building from 1980 might be worth 50 times more today, but the historical cost method just pretends that reality doesn't exist.
So what's the other path? That brings us to the fair value method. Now, if historical cost is the anchor, holding things steady, then fair value is more like a thermometer. It's designed to give you a live, real-time reading of an asset's current financial temperature.
With fair value, the past doesn't really matter. What we're doing here is measuring assets and liabilities at their current market value. In other words, what's the price they would sell for if they were put on the market today?
Let's go back to our house analogy. Fair value isn't the price on that 30-year-old receipt. No, it's the price a real estate agent tells you that you could probably sell it for right now, this very week. And as we all know from watching the housing market, that number can change, and change fast.
The main advantage here is pretty obvious: relevance. I mean, for things like stocks or real estate, knowing what they're worth right now is incredibly important for making good decisions. But all that relevance comes with a huge risk, and that risk is volatility. If the market takes a nosedive, the value of the assets on a company's books goes down right along with it, which can make a perfectly healthy company suddenly look really, really unstable on paper.
So what we have here is a classic showdown, right? On one side, you've got the stability and the pure reliability of historical cost. And on the other, you have the timeliness and, let's face it, the relevance of fair value. This choice isn't just some boring accounting rule. It's a fundamental decision about what you believe value truly is.
Let's put them side by side. Historical cost? It's objective. You can verify it with a receipt. It's stable. But its big weakness is that it just ignores what's happening in the real world, so it gets less and less relevant over time. Fair value is the total opposite. It's super relevant. It reflects today's reality. But it's also subject to the whims of the market, that volatility. And it can be tough to pin down when markets get chaotic. You see, each one gives something up to gain something else. Okay, so we keep using this word volatility. But what does that actually look like for a company's bottom line? How much can these swings in the market really change the numbers on their financial statements? Let's make this real.
So imagine a company owns an office building, and they're using the fair value method. Back in 2022, the market is on fire, and that building is valued at a cool $10 million. But just 2 years later, by 2024, the commercial real estate market has tanked. The new fair value for that exact same building is now just $6 million. That's a $4 million loss that the company has to report on its income statement just because the market changed. That right there is volatility in action.
So you might be thinking, okay, this is interesting for accountants, but why should anyone else care?
Well, because this choice between historical cost and fair value has huge real-world consequences for literally everyone involved with a company: investors, employees, even customers.
So here's the bottom line. The method a company chooses to use directly shapes our perception of that company. An investor who's looking for growth, a banker who's trying to assess risk, a manager making a big strategic bet. They will all see a completely different picture of the company's financial strength depending on which valuation method is being used.
Just think about who is looking at these numbers. A conservative lender, like a bank, they probably prefer the stability of historical cost. They want to see a solid, reliable baseline. But a fast-moving stock trader, they need the most current, up-to-the-minute fair value to make their trades. And what about a smart, long-term investor? Well, they're going to look at both. They'll use historical cost to understand the company's foundation, and they'll use fair value to get a sense of its current potential and its current risks.
And that really brings us to the most important takeaway here. There is no single, universally correct way to measure value. It just doesn't exist. The right number always depends on the question you're asking and the decision you're trying to make. Value is all about context.
So I'll just leave you with this final thought to chew on. If you're about to invest your own hard-earned money into a company, which number would you put more faith in? The stable, verifiable anchor of the past, or the relevant but potentially shaky thermometer of today? Your answer tells you a lot about how you think about risk and reward.